Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by Cody Cox. So, Cody, how you doing?
Hey, I'm doing great, Dan. Thanks for giving me an opportunity to come in and chat with you.
Yeah, anytime. It's kind of overdue because we've known each other for quite a while now. I've been meaning to have you on. So maybe we can start off. You can tell everybody a little bit about your background and what you do in the mortgage industry.
Yeah, I can do that. Thanks a lot. Well, I've been in the mortgage industry for 37 and a half years now. I started off, and I affectionately call myself, I'm just a humble mortgage guy from Eastern Oregon. I started off with a regional mortgage loan servicer in Walla Walla, Washington, a long time ago. And I was the guy that when you called the 800 number to talk to your mortgage company, I was the guy that answered the phone. So I spent 2 years in that position learning all the kind of various issues that a home loan borrower could come up with and how to try and work out with them and make sense with them, whether it be insurance or taxes or payment issues, and just kind of the single point of contact. My loan numbers ended in 86 to 99, so those were the ones that I had. Anybody that had a loan number ended in those digits were mine. And then in 1984, we moved to Portland, Oregon, and I started working for the largest savings and loan in the Northwest and became a commissioned loan officer. I was with them for a whole lot of years as a loan officer, and then made a transition over to another, at that point in time, became the largest savings and loan in the Northwest. After the first one went out of business, then I worked for Washington Mutual for, I think, 7 or 8, 9 years. And so I was a loan officer with them, and then I turned into management, was a sales manager for them for a number of years. And then, like a lot of the savings and loans, went out of business as well. Then I started working as a wholesale account executive for a national mortgage company as a home loan, as a broker. I was one of the guys that when they said, when a broker would say, I have 100 different lenders I can choose from. Well, I was one of those lenders. And then they kind of went out of business. And so I worked on my own for a while. I flipped a house in 2009 and, walked away with just under 6 digits of profit on that. Worked out real well. And then I started working for the state. So hopefully the state doesn't go out of business. So that's where I'm at right now. I actually manage a home loan program, both the origination and the servicing side of a home loan program for the Department of Veterans Affairs in Oregon. And it is a major mortgage company, and it is a program that is different and distinctly different from the federal VA program. It's our own little niche. So I get to manage that as well. We've got about $375 million under assets, and we're originating between $70 to $100 million in new loans every year. But sometime back in about 2013, 14, 15, I started buying notes for my own portfolio. I asked a guy that's pretty well known in the mortgage industry, or in the note industry, what's the best way for me to get involved in this and actually start working with other investors to assist me in funding my deals? And he said that the best thing you can do is show the results of using your own money. So I stood up a couple self-directed IRAs, started buying some notes, a couple in the Oregon area, and one of the ones I used in one of my IRAs, we ended up doing a deed in lieu. I had to chase the homeowner through Southern California and finally caught up with that person and signed a deed in lieu. And within 10 days, we had it on the market and closed it. And I walked away with 103% return on investment in my IRA. So that was that. When you do something like that, it kind of gets you motivated to do it again.
Sure.
And so we took the next step and started working with joint venture investors. And I stood up a company then called Trinity National Holdings. We are in the process of liquidating all the assets in that particular program in favor of a new model. Trinity, kind of gotten in a little bit of a dilemma, and I don't mind sharing this story with you because I think that it could be benefiting other folks who are looking to do joint venture investors, because there's something called the Howey test, and the Howey test deals with securities. And basically, if you are going to bring in investors, and if those investors' sole purpose is simply to fund your transaction with an expectation of a return, and if you're the lead note purchaser on that, and you're going to do all the work, well, the government, the SEC, and a lot of state regulators consider that as security. And you either have to have your security registered, or you have to have it, online with them that basically shows that you are meeting the requirements to issue securities. And so I see a lot of folks out there that are still, using joint venture funding and doing all the work, and technically that's a violation of security law. And so, I had somebody here local that was not one of my investors. All my investors were happy for the most part of what we were doing. And that particular person here locally, who I was trying to help, trying to mentor, trying to get them started in the note business, decided to call the Oregon Securities Office. And they are required that once somebody calls in, even though I wasn't doing anything technically wrong, I had to go through an investigation procedure with them. And so, one of the things that we know as note investors is we try and understand the law. And, if we understand how a law comes into play, at least on the state level, is they start off what's called a legislative concept. Somebody gets an idea that we need a law about a particular subject. So they write up a legislative concept, submit it into the legislature, who turns it into a bill. And provided that the bill goes through all the scrutiny, they go through all the committees, being voted on in the open house, and then goes over to the Senate, and then it gets signed by the governor of the state. It then becomes law and gets added into what's called the statutes or revised statutes. And we all kind of know what the laws are and are able to research the various laws of a particular state. But the thing that happens that I think we very frequently forget to do, or maybe we just don't know what to do, is when that law becomes law and it gets submitted to a specific agency to administer that law, that agency writes out rules on how to administer that law. And so oftentimes we know what the law is, but we fail to look at deep dive into what the rules are that administer that law. And so at the end of this investigation by the state, there was one little rule that I missed. And so we negotiated with the state. They fined me just a little bit, not very much. And so we decided, after some advice, is just basically to rebrand. So we are in the process, like I mentioned, of liquidating Trinity National Holdings and all the assets on that. I think I've got 5 or 6 notes left that we're working through, and stood up a new model. And part of it involves, being what I call my media magazine. Basically, I'm an online media magazine, which is where my banner of funding factors comes in. And that's what I have online with Facebook and LinkedIn and a number of other places. I have an emailer that I started gearing up again. It's all under the banner of funding factors. And so that's a magazine that's all things related to note investing and mortgages, for that matter. But we also stood up a fund. I can't speak too much about the fund, but we have that going, and that's really what my model is. And the model's changed over from dealing a lot with non-performing notes to establishing cash flow and dealing with performing notes. And so we're in the process of building that up, and we are really into it. It's really working well. and we're getting really close to deploying on that. So that's kind of, where I've been. Right now in the last 9 months, I've been trying to build my databases, trying to get a hold and make contact with a lot of asset managers to look for product. And so where we're going into the next 5 years is working this fund. So I'm excited about where we're going to.
That's very cool. That's a long, history. And that, so when you started in the loan business 37 years ago, was that when interest rates were super sky high, or was that actually after that? Or?
Actually, they were still in double digits at that time, but I was on the servicing side of it. So all those loans that I dealt with were from a servicing perspective. And there was a lot of different kind of loans, step payment loans, FHA type things that I had to learn how to deal with. And then when I made the switch over to the origination side of things, the first week that I was a commission loan officer is when the loan rates actually went into 9.9%. They actually went to single digits for the first time. That was in March of 1986. And I became a commission loan officer then. And that first week, I took 18 loan applications. And so if I took a loan application, if somebody wasn't already ready for me to sit at my desk, I turned around, because that's where my old IBM Selectric was on the back, and I started typing out verifications of deposits, verifications of employment. That was the time when we all huddled around the Credco credit machine and waited for that stuff to type off on Tuesdays. Came over on Tuesdays of each week. So yeah, there's a little history there. I've seen a few things. It's like I tell my kids, I was born at night, but not last night.
Yeah, it would have been a lot harder to work from home like everybody's doing now.
Yeah.
COVID and everything.
There was no laptops, there was no internet, there was no real wire type thing. That's when it was IBM. I think it came out with old Lotus 123, and you might remember that.
I do, because my dad used that up until I think around, it was into the 2000s, just because he had used it for so long and only used it for certain things, and so that kind of worked. But that was actually the first spreadsheet program that I learned when I was like 10. I started to do that. But so now, where do you see things go? So and for perspective for people who are listening, we're recording this on April 6th.
Right.
So things are, changing kind of week by week with the virus and everything. So now, where do you see things going over the next couple years, or what are your plans for note buying as we go ahead? 'Cause there's obviously a lot of uncertainty and kind of a lot of things are up in the air right at this particular moment.
Yeah, I think the key that's going on right now is liquidity. On our side as note purchasers, hopefully we have the liquidity or access to it in order to make acquisitions when that time comes right. On the servicing company side of things, or maybe the note sellers, there's a lot of conversation about lack of liquidity. Because when a mortgage servicer in the big boy era, which is, I call it the big boy type of things, because it's a little different than the servicers you and I might be used to. Mm-hmm. They sign servicing agreements that basically they have to use their own capital to advance out funds. They have to use their own capital to make sure that investor still gets paid. And there's a squeeze of liquidity on that, and they expect it to get worse as more and more borrowers are failing to make their payment. And then of course, liquidity is a requirement by the feds that they have a certain amount in backup just so they can make sure they can continue servicing. So oftentimes what I'm seeing, and right now my email is just simply flooded with a lot of tapes coming through from a variety of different sources, non-QM agency, a lot of scratch and dents coming out right now. Because that secondary market in a lot of ways is essentially closed. And so they're looking for a place to sell these notes, these tapes. And hopefully guys like you and I are in a position that we can, take advantage of that. And I like to think of it as another opportunity to help homeowners too, because, we're in it, for our investors, but we're also in it for the homeowners. One of the things I've said in the past is I spent the last 35, 37 years putting people into houses. I want to finish my career keeping people in their houses. So it's a nice opportunity to look forward and say, this is something that we really can take advantage at our level, because the big servicers, they're more concerned about their liquidity and spreads and servicing value, and they're not apt to help, that loan level borrower. And the other thing is here's another thing to think about is, the government recently came out with an announcement about forbearance plans. The CFPB has some stuff out, but none of these servicers really have staff in order to deal with the forbearance requests that are coming through. So I think that's more of an incentive on their sides to try and sell some paper
to reduce their reduce their workload, if nothing else.
Exactly. Yeah. Number of different reasons they would want to do that, but just having a trained staff, because what's the curve on that going to be? The training curve on that. So there's a lot of things happening in that realm that I find very, very interesting. And I think guys like you and I are pretty well, positioned to help out and, relieve some of that burden and make a win-win for everybody.
Yeah, absolutely. Because I'm thinking about, like, if I was a big loan servicer, how would you, even if you knew you needed staff, it would be hard to staff up when everybody's working from home. I mean, you can do it, but it seems like it's going to be a bigger challenge and it's going to be a slower ramp up.
Well, yeah, and in my day job, I'm trying to hire somebody. I've got a position that, we've made a decision on and a number of different things that we're trying to do there. But how do I fill that position? Because, I could still probably do a recruitment, but how do I interview that person? I suppose I can interview it over Zoom or whatever type thing is, but how do you train them? How do you get them in the office? And so, yeah, those are all kind of the challenges that a lot of mortgage lenders probably a lot of lenders, a lot of companies that are actually hiring are having that same kind of challenge.
Because even if you did have them in the office, like I know from my project management days as an engineer, if you needed staff on a project and you had to bring people on, you often had to train them up on that project. So it would slow you down. It would slow down the people who were already on it. So if you wanted to bring people on, you were going to have to pay a price in productivity before you started gaining again. So that's got to be brutal on these servicers that are already just neck deep in paperwork and emails. Yeah, to your point, it's probably easier just to start selling some of those loans as opposed to trying
for myself, I thoroughly enjoy teleworking. I like it a lot. I can set, I've got my work system set up here. We've got a VPN that we go in, and I thoroughly like that. And fortunately, I've got an excellent staff that is very creative and intuitive, and they take care of things with, for the most part, minimal involvement by me. Plus on those downtimes when I'm not dealing with that during the course of the day, then, there's other stuff I can take care of. And so I thoroughly enjoy that. Now, again, the part of it is oftentimes this being a note investor requires you to be out in the field, as you're working with other various investors or other contacts and socializing and things like that. I used to like to go to the local Portland area Real Estate Investor Association meetings, but those are all not happening anymore. So there's a lot of things on both sides that are it's a whole new way of life, and the thing is we don't know how long it's going to last. It could be next week. I know that at least in the state of Oregon, we're basically at the stay home, stay safe till the end of April. I know there's other states that are, like Virginia and Florida it's all the way into May. So I don't know where you're at as far as what Colorado might be.
Yeah, Colorado, I mean, we're on the full lockdown. I'm not sure. Because it changes all the time. I can't remember the exact date they've set it for. I think it's at least through April.
Yeah.
At this point. But and I assume whatever it is, it'll probably slide out a little bit before it's all said and done. So I'm not even trying to predict when it's over. I'm just kind of doing my thing.
Yeah, that's what I'm doing, trying to keep my head down. And I had no manager said, keep your head down and wheel in the ditch and just keep doing what we do best.
Yeah, exactly. So how are you adjusting your pricing? I mean, are you bidding any of the tapes that you're getting?
I'm playing and role playing more than anything else because I'm not quite in a position to submit an active bid. And so our efforts right now are trying to develop a little marketing plan I've spent a lot of time during this downtime and even prior, like all the way back to this summer, when the previous issue that I referred to, kind of concluded, that just developing a better and bigger database that I can, search for note sellers. And, right now it's ballooned up to almost 4,400 names. And I'll be paring some of those back, but those are just asset managers or people that look like they have access to notes. And so, we're trying to find a way to get that out in segments. So that's kind of where we're at on that side. Plus, I'm trying to make the conversation to build up my investor base as well. So I guess to answer your question, Dan, is I'm not quite making in the position to make bids yet. Practicing my bids, of course. And paying attention to, a lot of you folks out there on what you're doing, the comments, reading the newsletters. I've got newsletters coming in from a number of different folks, and then a lot of different financial gurus, and trying to find out, where do we back off? If we were going to make a bid at, 70 basis points, are we going to back off to 62 or 60 basis points right now? And there's some sellers out there that are probably willing to take that kind of haircut. Just because of their need for liquidity. So, it's a grand opportunity, but again, you got to be careful because, even though you may be able to get it at a little better discount than you did 2 months ago, there's also the thing where you have to be careful about what that value is, and the asset value or the value of the property itself may have a decline as well. So it's a little bit of a juggling act. So, you hope you get it right.
Yeah, absolutely. Yeah, it's been a tough one because there's so much uncertainty.
Yeah.
I've been kind of operating on the theory that at some point we'll have a pretty big wave of non-performers.
Yeah.
In the market, but I don't know if that might take a while to filter through the system. Some of that may take 12 months. So.
Yeah, and I have a theory about those non-performers you just referred to, because I kind of think that they're probably ones that you can get back performing pretty quickly, pretty easily. I think a small percentage of will go all the way through the foreclosure, but these are people that, they were hung up, they went non-performing because of this coronavirus situation. And assuming that passes within a relatively quick time, and hopefully the forbearance that went on with some of the other major servicers before they sold these out, there may be a better opportunity to get those reperforming than they were back in the 2010, 2015 kind of time frame. So that's just a theory I have.
Well, because hopefully this is more transient, right? If someone's employed at a place that's shut down, for a few months, then hopefully if that gets back open again, they'll be working, and it'll just be kind of a transient thing. I just don't know how much underlying damage will get done to the economy when you sort of, shut a major portion of it down for that long. That's kind of new territory. I don't know if there's ever been a time in history where anything like this has quite happened. But we'll be in touch afterwards too. One of the things I've been doing, I've had some time, is doing a lot of research on sellers, and I've been building a map of the market. So, I haven't actually started reaching out to them yet because I'm just kind of waiting to see how things settle out. A little bit, but depending on what I lay into and what I find, I may need help, to take it down. Because your point, you mentioned kind of the big boy world of loan trading. They're usually trading in relatively larger amounts that are hard for an individual.
Yeah. And I think you make a good point there, that it is an opportunity, for guys like yourself and some of the other folks that we do know, to join forces to agree. And, if somebody wants to sell out a $25 million tape, that we can't take it down by ourselves, but it's kind of an all or nothing situation that the group of us could probably take that down, jointly and make that happen. So, that's the way to do it. And one of the things I wanted to make sure I talked about in my model change, going away from the non-performing joint venture type of things over to a performing, fund type base, is spreading the risk. I think that's an important thing for us to look at, is that, typically in a joint venture, you're looking at one asset secured by one set of dollars. And so all the risk is focused into that one particular asset. Whereas in the fund model, that risk gets spread over all the other assets in the fund, and I think that's an important thing to think about. When we're going into whatever is supposed to happen or whatever is going to happen here in the next 6 to 12 to 18 months. So trying to mitigate that risk and spread it over your entire holdings, I think, is an important part of what I'm trying to do.
Yeah, I agree, because I've had that happen before on non-performers where I've run into a couple bad surprises on the inside that you couldn't have known about before. Yeah, and people get upset when it's one note, but if that was one of 100 across the fund,
Yep.
then it all kind of washes out.
Right.
And doesn't really matter. So, I mean, how are you going to approach, performing notes in this environment? Because I've been trying to think about how to model those, and I'm not quite sure. Some of them will flip non-performing. I'm guessing some percentage are going to miss payments and then hopefully come back. But I haven't been able to wrap my head around, is this going to be like 10% of loans, or is this going to be more? I don't know.
Well, a statistic I saw earlier in the day that came out from a hedge fund was that in the height of the economic recession that we had here, in 2010, 2011, 2012, that the Fannie Mae delinquency rate was 5.6%.
Mm-hmm.
And so, is this something that's going to be more than that? It's hard to tell at this particular point in time. I've also seen some charts that show the unemployment claims that occurred during that time, and all of a sudden the spike that went straight up here last week.
Mm-hmm.
And so how are you going to deal with that? Well, there's got to be a way to mitigate it. I think that you just have to, be smart about your analysis and be a little bit conservative for right now, but also know that there are opportunities are there. And again, if you spread the risk over a number of different notes in a fund model, and if 7 to 8% of those go non-performing, the other ones are still performing. So that's like 93% that are performing. So I know that oftentimes we look at the worst case scenario, but I don't want to lose sight of the best case scenario.
Yeah, because you can't. I mean, if you price for the worst case scenario, you'll never buy anything.
Yeah, exactly. Yeah.
You'll never close on anything. But yeah, that fund model does make it a lot easier when you can spread it across several bets. So very good. So I guess we're getting pretty close to wrapping it up. Anything else you wanted to cover while we were here, or?
Well, it's going to be a fun ride. Last year for me at least has been a pretty interesting ride. I feel I've recovered from it pretty well, and I've kept my path, and I think we're just about ready to do something I think is going to be pretty phenomenal. And one of my goals, of course, is to do what you did. I want to do what you did, and that's do this full time. And I think that there is an opportunity for that to happen. I feel very blessed that I still have the day job that I have, but I also see really, really awesome things coming down on the road, and I look forward to that. So that's kind of where my thought is. I keep, plugging away to the prize of that high calling that I know is just right outside there.
Yeah, I mean, as terrible as this whole crisis is, I think, at some point it will, for no investors, it will create some opportunities.
Right.
There'll be at least, some silver lining to all the bad stuff that's been.
Yeah, and we get the opportunity. I said it earlier in the podcast here, as we get the opportunity to help more homeowners, more borrowers stay in their house. And, and that's one of the things we have to keep in mind as well, is that we're actually here in providing a positive service to everybody else. And that's what makes it a win-win-win for everybody involved.
Yeah, just this morning, I got an email from a servicer where a borrower said they lost their job and asked for to move 2 payments to the back of the loan. Mm-hmm. But what was nice was that they actually had a signed letter from their manager.
Yeah.
At the restaurant. And so I just responded and said, yeah, I approve. And I actually had spoken with the borrower previously, so I just sent her a text and said, hey, I got this, no problem.
Yeah, that's awesome. That's what it's all about.
Fast. Yeah, big hedge funds and stuff aren't going to be able to.
Exactly.
To do that. So cool. Well, Cody, thank you very much.
You're welcome, Dan. Thank you again.
I really appreciate it.
All right. I'll talk to you soon.
All right. Thanks.
Bye-bye.